This episode is sponsored by First Home Mortgage. I want to talk about the system behind home ownership, about lending, about debt, about financial habits, and why so many of us feel like we're literally locked out of the home buying process. Because I hear it all the time about how nobody can buy a home anymore.
Your credit score is not a representation of your financial wellness. Let's start there, right? You apply for something. The FICO algorithm simply thinks you're getting in more debt. So just in case, let's clip you for a couple of points.
Hi, everybody. This is Matt Rhine on another episode of All Roads Lead to Real Estate. And I have a guest with me today that I think is probably more informative of a topic than some of the others. I recently had a very impressive guest to kind of make a different path than some of the usual ones. I had my 9-year-old with me.
There you go.
We were talking all things real estate through the lens of a 9-year-old. So you missed that episode. I could have had you on there.
I'm sure we'll check it out on Spotify for sure.
Yes, please do. Like and subscribe, of course. But the guest I have today, I was just going through how I should pronounce his name. And of course, I say it horribly, but it's Juan Burgess.
There you go.
I said it pretty well, but he says everyone calls him JP. And so he is the regional director of a company called UQual. Mm-hmm. And the reason why I wanted to have you on today is because, to be truthful, I have no one in my little bubble here in Maryland that I actually refer to and trust consistently. I've had people come and go that are in what I refer to as credit repair. Mm-hmm. And boy, is it a scammy business in general, from my experience. And it's not always very helpful. It can be expensive. And many of the people I've referred out never come back because they just get lost in the sauce. They get discouraged. It's a mess. And so I want to give you a proper introduction before we start going back and forth. But I want to just start on the outside here. We're not just talking about credit, and it's not just credit scores, but I want to talk about the system behind home ownership, about lending, about debt, about financial habits, and why so many of us feel like we're literally locked out of the home buying process. Because I hear it all the time about how nobody can buy a home anymore, right? And so
too expensive, inventory, blah, 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 right?
All those things. And I know that your company doesn't just help people with credit scores. They help people with education, coaching, the technology behind it, and action plans to get going. And I want to first say that this is not just a small space. And I from my research prior to having you on, it looks like this is at least a $6 or $7 billion industry just in the United States. And the availability of credit is just everywhere now. Yeah. I mean, you can borrow money to go, obviously, to dinner. I mean, and it's not just a credit card, right? It's on your phone. Yes, you're holding up your phone. So it's everything. And so I want to help people understand whether you're a first-time home buyer, a repeat buyer, an investor, or if you're someone that is looking to have better financial habits, even if you're not in the market today. Like, this is the conversation I want to have with you. So I want to thank you once again, JP, for joining me.
Of course.
And it's exciting to have you. I've never had this topic covered here on the podcast.
Awesome. It's going to be fun.
Yeah. So, well, first off, help me understand a little bit about you, a little bit about the business that you're in before I get going. So help me understand, how in the world did you get into UQual and the credit business, so to speak?
So I moved here from Argentina with my mom and my two brothers. Unless you're coming nowadays from Argentina, Spain, and like some parts of Mexico, there's no such a thing as a credit system, right?
Right.
And so when I moved here, the first thing my mom got told is, hey, you need to go get this thing called credit. How do you do that? Well, you got to go buy a car. Obviously, with no credit, you go to a buy here, pay here.
Yeah.
Let's save time and say that ended up horribly.
Sure.
Right? And then when I was 18, I got my first Capital One credit card, right? $300. Here I am thinking, it's free. It's free money. And then I started getting calls from the collection agencies, not understanding it. But the one that really got me is there was this little tent. I remember going to the store with my mom, and you come out, a little blue tent, and it's called Royal Prestige. And they sell pots and pans at very ridiculous interest rates. And I kind of saw how that hurt my mom. And the last piece of it is, I'm seeing these kids that I'm going to high school with driving this beautiful cars. I'm like, I'm working at Bob Evans, man. Like, how are you doing it?
Yeah.
And that's when I started getting into the world of credit. I later on went on to work at a debt settlement company. And, there's a place for everything.
Sure.
And the more and more and more that I started learning, the more I realized, like, hey, this is not available to everybody. Like, why am I not, just like in high school, they taught me how to balance a checkbook. Why am I not being taught what the credit system is, the fact that there's different algorithms, the fact that things are measured completely different. So that's kind of how I started there. And on a faithful December 7th of 2020 is when I started with UQual. And UQual was a concept that was created by Kyle, our owner and CEO, super, super smart guy, heck of a person. And really what we wanted is to bring a holistic approach to buying a house, right? And so we are a fintech platform. We do use AI, but the biggest difference is we're the only loan readiness company, and we specifically work with mortgage professionals. It is a mortgage fintech platform and really designed for loan officers, for real estate agents that are trying to take those clients who heard no and make that no become a no yet. Because we've all gone through it, right? Hey, I have a 620 credit score, but I don't have any money. The market's not for me. Or I have a lot of money, but I have a 415 credit score because of divorce, because of medical issues, whatever the case may be. So we're bringing and truly marrying financial wellness with credit improvement, with the ultimate goal of getting people into a home loan. And again, being mortgage centric is the biggest key. When you talked about credit repair, credit repair has that scummy feeling because of companies that have done what they've done since 1993.
They just take people's money and they keep them on the hook forever. And I don't think they get a lot of results. I've just spoken to so many people over the last 20 years that have been through it a couple times, or they've tried, and it's almost like quitting smoking. You ever heard quitting smoking is one of the easiest things in the world to do? I've done it 15 times. Credit is this thing I don't think most people understand. I'm impressed that you learned how to balance a checkbook in high school. I don't think most people know how to do that. Heck, I don't know most people under 30 even have a checkbook.
Yeah, we don't have to anymore, right?
You don't have to.
It's all done on your phone.
But I think it's what this does to me, and the reason I went into school to learn finance, that was my degree, not because I wanted to be on Wall Street necessarily, but I knew what I didn't know. Mm-hmm. I was smart enough to know I didn't know, and I think when people don't understand what credit is, and not just that, but how the financial markets work, and that not all debt is bad debt, and debt equals leverage when used appropriately. Like it's these beautiful, wonderful aspects. And by the way, it's one of the reasons, I know, like you just said, how you came to this country. It's one of the beautiful things about America is that we have access to relatively inexpensive leverage.
Yes.
And it's a way, it helps people who understand it get really rich and have tax advantages. And if you just grew up in a household where like I did, we grew up on a farm, any debt was bad debt because they didn't understand it.
Correct.
Right? It's just like, that's a tough way. It's just like it's the parents protecting them, saying, just don't look over there because I don't know how to help you. Don't get too close to the pool. Well, teach me how to swim.
Exactly. Well, and I use in your world, right?
Yeah.
Dave Ramsey.
Yeah.
As a Christian, I love half of the content. The other half is I'm not one to tell you don't use credit. I want to teach you how to use it.
Yes.
Right. And that's my thing when, for example, credit cards. You and I know that, credit cards is a very simple way to get into debt. We owe more money on credit cards than we ever had. But that's because we never taught people correctly how to use them and how to leverage them, because for the sake of your credit score, you have to have a credit card.
You should have a credit card. Everyone should have a credit card. I mean, my mother, for example, had no debt. She was very, very proud of that later in her life. 0 debt, no house, no nothing. Very proud of that. Her credit score was not good because she had 0 debt. She had nothing.
Correct.
And she did not have a great credit score. So she had to get an education to figure out, how do I even have a good credit score? She thought she was doing well. She had money in the bank, not rich or anything, but she had money, and she had she didn't owe anything to anybody.
Correct.
And she thought she was doing really well in that respect. But in reality, you have to show people that you have the capacity to pay them back, to have a credit score.
And it's a data set, right? Hey, how can you manage a 30-year mortgage? How can you manage a 5-year car loan? Can you manage a revolving account that you're making purchases and payments every single month?
Right.
Without that data, if you are the bank, you're not going to have the data set that you need to feel comfortable lending to that person, right? But just to put a pin on the whole credit repair thing, and we'll move on from that. there's big changes in that industry coming July because of the fact that it has that bad name.
Yeah.
One of the biggest things we're hearing that is currently in effect, like they're not allowed to sell credit repair via phone. And on top of that, you are not allowed, as a credit repair company, you are not allowed to charge people upfront any type of fees for 6 months.
Interesting.
And on month 6, I have to come back to you and say, hey, Matt, here was your credit score. Here's a copy of your credit report. Here's what it looks like 6 months later. If you do not have tangible results, you're not allowed to touch that client.
You mean touch the client or charge the client?
Charge the client.
Okay,
you cannot charge the client for whatever you...
And this is going to take place in July of 2026?
That's already in place.
It's already
and
in
one
place.
That's coming in July, it's the same going to apply to companies that do this via internet, right? So websites. Okay. Again, right, that's why we came up with the concept of loan readiness. And really it's when the best type of client you're going to get that are going to go through that journey, because it's not, hey, here's a magic wand, poof, now you have a 760 credit score. It's people that are looking to buy a home, which is why we work with mortgage professionals. Right. So just being intentional about the type of client that we want to help, right?
Well, and I think the issue that I think can become a hot topic here is that it is actually, I believe, the people that have the financial education, it's why the rich get richer. In my humble opinion, I think some folks that were born in a system that had the education at home, it's easier. It's a big step up. And I think certain neighborhoods have a more of a challenging time, like socioeconomically, to step out of it because there's no education there. And so I think the internet and specifically companies like yours might offer people an opportunity to know something that maybe was never taught at home.
Correct.
And that can truly help them get into a whole different world. Like their life and their kids' lives can be totally different than maybe what their parents had.
Well, and for, again, you being an agent, right? You have the opportunity to literally change the legacy of the family by helping them get into a home.
Right.
Like people take that lightly, I think.
Yeah, it is. Now, granted, I work for a brokerage that has the name Legacy attached to it. So, yeah, some people lean into it maybe as a marketing ploy, to be quite frank. But the reality is it does. And it's one of the reasons why I went into real estate to begin with, is because I started to understand how leverage can allow you to change the generational path of your family tree. And it's true, it can absolutely do it. And it's wild. I know it's wild what I've been able to amass with very humble beginnings, and I'm continuing to do. It's getting easier. The older I get, the more I already have. It snowballs. It's becoming easier to do things than it ever used to be.
Correct.
And I think the way that I'll judge how I feel about myself, my golden years, it's like, how am I able to then? It's one of the reasons I do this podcast. How can I help give back in a meaningful way?
Service.
Right? It's a service. It's like I managed to get a few more rungs on the ladder than I even thought I'd do. Can you extend the ladder back down to those and help more people up? And I think that's an opportunity that people, even a little podcast like that, it's another voice that someone might resonate with someone if they don't listen to Ramsey or these other folks that have been out forever.
Yeah, and think that if out of this podcast, 3 people decide to make or figure out the right steps to take in order to, maybe homeownership is for me, because I heard these 2 guys talk about the steps that I should take to get ready.
Right.
Because you said something about credit earlier, that people don't participate or something like that. But it's really funny, because when do people truly start caring about credit?
Yeah. When they want to buy typically a house. Mm-hmm. Oftentimes it's a car. I hear people way overextend themselves, these car sharks that get you because you don't have great credit.
If you have a pulse, you can get a car loan.
Yeah.
Right? I just saw somebody in this I've never seen before with an 84-month car loan.
Oh, my Lord. Yeah.
84 months. Most cars are not going to last you 84 months. Let's start with that, right? And the fact that you have companies that are giving out 14, 15, 16% rates on a car loan, but here we are complaining about a 6.25% rate on a mortgage. It doesn't make sense. And kick it up a step, right? Yeah. You're paying 27% on your credit cards.
Yeah.
None of those things are a value-creating asset like a mortgage is.
Right. Well, we're at odds. So as we go through this, it's, as I say things, we are a consumer-based economy. for now. And so we've been that. So we actually need to keep spending. And so the government actually incentivizes all of us to spend. I don't think there's an incentive for them to necessarily teach us to not do that. So it's interesting. The more I've been in this world where I get to understand people's finances, the more this topic means to me, because I'm dealing with people's conversation. And the worst is when I see they haven't even opened the book, so to speak, to learn about this, and they're 50 or 60 years of age, and it's tougher. They have a lot less time to get, they still have time, but it's not as much. If we can help educate people earlier, I think the profound compounding effects of time is impressive.
And I would 100% agree with you, except for one thing. There is no book.
Yeah.
If there was a book, I wouldn't have this job.
Yeah.
Right? I wouldn't be here because everybody would be running around with an 800 credit score. Now, what would happen to the system if all of us are running around with an 800 credit score?
They'd have to change the system altogether. Well, when I would say book, I'm really referring to they have enough understanding to recognize that they should be thinking about it more in a more meaningful way. That's kind of what I meant by that. Like,
sure. What I would want, like if you ask me, like, hey, what do you mean by a book? Why are we not giving the basics of finance and credit in high school, and then you go deeper in college?
Sure.
And understand what is FICO, what is Manage, what is this, what is that.
It's never discussed. What's crazy is I have a finance degree, I have a business degree. At no point in that education did I ever learn anything you just described. I learned about board of directors. I learned about the larger financial industry that, to be honest, doesn't affect me in any capacity at all today. Like, I didn't have even a basic understanding. And I took all these economics courses. None of it pertained to real life. I learned that after college. And
one of my best friends, Donovan, shout out to Donovan Lewis.
Yeah.
One of my best friends, he managed a bank, right? And same thing, investments and IRAs and all this different stuff. And then he came to start working with us, and his brain was hurting after a week because he couldn't understand, like, why are we not making this public?
Yeah.
And again, it comes down to, if you and I are credit card companies, right? We're not going to go in business to make a measly 5%, 10%, right? We want the 20s, we want the low 30s. If people are running around with an 800 credit score, we can't charge 20%. Because guess what? I don't have any of my credit cards that are over, let me think, 17%?
Yeah.
Because of my credit score.
Yeah. Well, it's all really interesting, but I want to kind of focus this a little bit so people understand. So if they want to know what your company specifically does, help explain it in a nutshell. I'm sure you do it every day of your life. So what's the elevator pitch as to specifically what you guys are able to do and why someone might call your company in the first place?
Yeah, so we work with loan officers, real estate agent, and mortgage professionals to help clients that got declined. Whether that is because of credit or finances, we put them within the UQual ecosystem, as I like to call them, give them all the tools that they're going to need to get them back to that loan officer, to that real estate agent,
right,
that originally referred them to us. I want to throw that out there.
I appreciate that.
So that they can then go apply and get qualified. The whole point under UQual is you qualify.
Right.
And that's the goal, right?
And I love the idea. It's like you're getting them ready. It's with a purpose. It's not just for the sake of having a higher credit score. That's great. Sure. But it's, what does it represent? Mm-hmm. And I think the first step is home ownership. And to me, of course, I love real estate. It's my thing, right? So I think about it beyond just living in the home that you own, but also beyond that. I think it's a fantastic investment vehicle for a lot of people that you have to have access to credit markets in order to do it for the vast majority of people.
Yeah, and if you didn't jump in NVIDIA at the right time or Bitcoin at the right time, you today cannot show me an asset that is going to get you the return on a mortgage. Well,
there's a lot of reasons, but yes, that is in large part correct. No one wants to lend at these rates and give you that much money typically unless they have a real asset behind it. Mm-hmm. And so that's the beautiful thing about a mortgage. So help me specifically understand who your I guess ideal client is. It sounds like I know what the company does, but is there someone that it sounds like it's a perfect fit for you when you speak to them?
So I like to break it down into two buckets, right? We have the person that didn't get declined, or the person that it's in the 680s. They're doing okay, but man, life will get a heck of a lot better if I can get to a 720.
Yeah.
So that's going to be my good to great type of client. Hey, We're going to look at what open and active accounts are there, what tweaks can we make. Is there a potential for maybe a late payment or something that happened 2-3 years ago that is not really dragging you down, but it's a pretty nasty stain to look at? So that's going to be the good to great. And then you have the person that did get declined. Because they're a sub, 590 credit score, most people can't get a loan under that. And you have a little bit of both. Obviously, right now, unfortunately, most people are that sub 600 credit score. And the other thing is you have all these online scoring models that, to me, are just giving people false hopes. And then you and loan officers have to do the work to explain to them why there's that. So again, there's two buckets there.
Is there hope for folks that are listening that have a 500 or below credit score
100%.
that have been told they can't? Because some people have had this issue and they've been quote unquote working on it for a long time and they can't ever seem to get ahead. So you see people that are able to get ahead and this is a realistic path that they can catch up, so to speak?
Yeah, 100%. It's knowing what to do, right? Like, I have a car and I can't fix my own car. And that's why we have mechanics, right? A lot of people are like, well, I think I'm just going to work on my credit and do it on my own. 6 months go by, you're up 3 points. That gets very discouraging.
Yes, it does.
Because you don't have the right strategies. Just like I'm not going to go and try to evaluate the price of a home. I'm going to call you. You're an expert at that, not me.
Yeah.
And so I'll give you an example without, future promise of performance or whatever. I worked with a lady down in Dunkirk. It took us 8 months.
Yeah.
But she started at a 412 credit score because not only did she have medical issues, but her husband passed away and a lot of stuff got dumped on her. And they didn't have money. They didn't have life insurance. They didn't have any of that, right? 8 months down the road, I get a picture. You can go look it up in Google. There's a Google review with my name on it. We did it. It took us 8 months.
So help people understand what are some of, you don't have to give her specific reasons and how you managed to do it, but give me the overarching idea. Are you able to call these companies and say, listen, I know she's owed $50,000 for this particular bill, like she doesn't have it. Do you renegotiate these numbers or do you collect them all and try to put them into a single payment that you can get current with? What are some of the strategies people are able to do? Or do you try to just fight them and get them dropped entirely? Or
So there's 3 different models out there, right? And they can all exist. They're all, in a sense, true at the same time. Number 1 is going to be debt settlement. So debt settlement is specifically designed, in my eyes, right? Specifically designed for people that are drowning on credit card debt and their financial situation is not going to get better. Right? I usually will never tell somebody to go that route unless you're 50, 60 or more $1,000 in credit card debt.
Go down what route specifically?
Debt settlement.
Okay.
Yeah.
And so if I owe $60,000, you say...
Let me rephrase that. I wouldn't tell people to do debt settlement unless you're staring bankruptcy in the face.
Okay.
Right? So at that point, what debt settlement companies do, and again, for some people, it's a very good thing. Hey, this person owes you $50,000. Unfortunately, they're going through this financial hardships. They're going to pay you back $25,000. It's going to take them 36 months. Okay, fantastic. That's that. The problem is that, as you know, paying a collection, paying a charge-off, or creating a new collection or a charge-off impacts your FICO credit score directly. The other one, and I don't really know how available it is because of economics, is debt consolidation, right? You have all these bills, these companies call your different creditors and try to arrange a new minimum payment for you.
Right.
There's that. What we do is we're actually utilizing an AI protocol, and we are leveraging the Fair Credit Reporting Act. So it's 169 pages long. It's a federal law, and it states, put into one sentence, it states that everything on a consumer credit report by law has to be 100% complete, accurate, and verifiable. The data tells us today that 7 out of 10 credit reports have errors on them. So if a client has a late payment, I'm not saying they didn't pay late. What we're saying is prove it. It's the right of the consumer, right? So ultimately, what we want is to take these items that are quote unquote questionable,
okay,
and get them removed from the report.
So if I can't prove that you can't prove, it's on you to prove that I didn't make that payment 3 years ago.
It's the reverse of the legal system.
Right.
Right.
You're innocent.
And,
yeah.
Well, in the legal system, you're innocent until you're proven guilty. The credit system is complete opposite. You're guilty, Matt.
Yep.
But okay, now it's a burden on them to prove to you that you are.
Now, because we know this, aren't they going to get better and better with technology to make sure in the future that, oh, I have all the proof for the last 20, like I imagine with AI and cloud compute, they're going to get really sophisticated if it's this, because I'm sure they don't want to write off billions of dollars, I would think.
You would imagine that?
Yeah.
But for example, right, since November of 2025 up to now, we now have 9.7 million people that got hit with late payments with student loans. The other day, there's a whole debacle, lawsuits going back between the state of Missouri. It's just a mess. And why did that happen?
Yeah.
Because people weren't correctly notified. So the way that it was explained to me in a sense is, hey, look, the student loan holder either sent a letter stating that, hey, you're coming out of the family, you're coming out of forbearance, whatever you had. And they sent that letter to your parents' house where you haven't lived for 25 years, right? Yeah. Or they sent you an email to your old high school AOL account.
Right, or your college email account or whatever.
Or whatever. And so did they technically try to notify? Yeah, well, you could have sent my team a messenger pigeon to get me on here. Well, did you technically try to notify me?
Yeah.
So it's those type of practices, right? Yes, technology is going to help, absolutely. AI implementation, absolutely. But at the end of the day, it is on the creditors to prove that that client did A, B, and C. And the second piece to that is that it's time limited.
What's the look back typically?
So usually they only have 30 to 45 days to return or to respond, right, to the investigation.
Oh, I didn't know that. So if they don't respond in a month and a half?
If they don't respond, they don't have the data, or they just plain and simple don't want to, that account has to be removed from the report.
Wow.
Right? That's how that works. Which is the same time, like a lot of people will try to call the creditor to try to quote unquote negotiate. And what's the first thing they're going to ask you? What's your full name? Oh, it's Matt Rhine. What's your birthday? Blah, blah, blah. What's your social? What do you think is happening?
Yeah, they're getting all your data.
They're collecting all your data. So
when your firm calls, do you give them all this information?
We don't call, we don't write letters, we don't make phone calls. It's all done digitally. So we are digitally integrated with the credit bureaus.
Interesting.
We're the only company that has that ability.
And is that a benefit to the consumer?
100%, because imagine the vetting process that we as a company had to go through in order to be able to say that, hey, we have a digital integration with the 3 credit bureaus. That gives us speed.
Yeah.
And when it comes to this type of process, time matters.
Yeah.
Time is super important, because how many times are you working with a buyer, right? They're under contract, life is good, blah, 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 out of nowhere, mystery medical bill.
Yeah.
Mystery loan from a buy now, pay later. And it happens. And then the deals fall through, right? Earnest money goes to waste.
Thankfully, I don't see that particular issue as much. What I see is people call me. They want to see, I'll teach you the life of a realtor very quickly. I'd love to see this $500,000 house down the street just popped up. I'd like to see it today, immediately. Wonderful. Is this the price range you're looking for? Have you started the process? Well, I'll figure out the price later and how much I'm pre-approved. I want to see the house. And so they always start with the house, right? No one wants a mortgage. They want a house. And then they don't want to see any of the finance. They don't want to necessarily look at that the mortgage side, right? The financial side. And it's really, and then if they love the home and you allow them in, which is challenging to say no, so we often do let them in, and then they love it, right? It's the perfect house. It's what we've been looking for. We've been casually looking online for 3 years. We found it. It's the one. I want it. Get it for me, Matt. And then we connect them with the mortgage at that point, because that's the first time they've agreed to talk to somebody. Then they find out about what you just described. And now they realize last time I checked, it was $700 or $680. I thought it was good. And now it's $580. And then the house is gone in 3 days and they're out of luck.
Yeah. And it goes back to people only care about their credit score when they need it.
Right.
And your credit score should be something that you have it and you don't need it. And if you need it, you have it.
Yeah, now I don't know how many people get these services. I get something sent to me. I don't know what you'll probably say it's horrible, but I have a credit monitoring service that once a month tells me my credit score, and it monitors it. So if my credit gets pulled, anything happens, I get notified.
No, everybody should have something.
And it's like $20 or $30 a month. It's not outrageously expensive. But do you recommend those type of things that everybody should lock their credit scores like and have a system like this?
I'm going to be super nice.
Yeah.
If you don't have medical debt, medical collections, you have credit scoring models on your phone that your bank is giving you.
Yeah.
Use that.
And that's free for most of us.
And that's free. Right. So it says on the back of your credit card company or your bank, like Chase, Capital One, they all offer some type of, but it's not that I signed up for it, but why do I use it? I want to make sure somebody's not out there trying to take out credit in my name, number one, right? And then it helps me because something that to me is very key, especially when I'm getting ready to use my credit, it's going to be my credit card utilization.
Yeah.
Right? We all heard that credit card utilization is 30% or whatever your limit is. Lo and behold, it's now 10%.
I want to say that again?
So
they want to keep all balances at the 10% or below number? Is that what?
Of your limit. So let's call it the good to great difference, right? And I never want great to get in the way of excellent.
Okay.
So when you're getting ready to purchase a home, let's call it tier 1, you will want all your credit cards to be below 30% of your limit. Your credit card is $1,000. Let's bring that baby down to $300 or less. The excellent tier, it's going to be 10%. Your credit card is $1,000. Let's bring that baby down to like $97, right? Now you're at 9.7% utilization. That is 30% of your FICO mortgage credit score.
Wow. No one's ever explained that to me. I've never heard of, and I'll get into it, that's a question I have. I've never heard a clear explanation, and to my knowledge, it's not really publicly available. Maybe you can dispel that rumor to me, that no one really knows exactly what is. It's like proprietary. It's a soup that no one knows the ingredients to, is how it's been described to me. Mm-hmm. And they have general ideas of what the ingredients are, but you're not going to know KFC's recipe. It's KFC's recipe.
Right.
It's in
the Coca-Cola mystery.
Right. It's the mystery. And therefore, but these are some of the main important things. But are you telling me they have now published, or is it still a relative guesstimate as to what this is? Do you know exactly how to get a credit score up 20 points?
I can give you the FICO algorithm breakdown in like 2 minutes.
Are you kidding? And so this is public knowledge. This is not.
It is.
Well, I'm telling you, I can't tell you how many people have told me that I can't tell you.
So I just want you to imagine a pie chart. We're going to cut it in 5 pieces.
Okay.
Right? And this is the average between FICO 2, 4, and 5.
FICO 2, 4, and 5.
Who uses FICO 2, 4, and 5?
Okay.
Like, that's a question, sorry.
I don't know. I couldn't tell you.
Mortgage lenders.
Okay.
Right? We've been using the same algorithm since the late 80s. Same thing. And for a long time, but then you have the internet and you have people that quit their job at this particular company and go somewhere else, and now they're angry, and so the information got leaked out. It wasn't really leaked. It should have been out forever. So pie chart. 35% of your mortgage algorithm is very straightforward. It's your payment history. Matt, do you or do you not pay your bills on time? Right? Do you or do you not have late payments, collections, repossessions? Well, it's not a repossession because I turned the car in. Same thing. Right? The FICO algorithm does not know the difference. So do you or do you not pay your bills on time? That's 35%. 30%, managing credit cards. And people don't like me for saying this, but you don't need more than one credit card to achieve excellent credit. Because somewhere down the line, somewhere in like TikTok University, they heard, oh, you need 3 credit cards. No, you don't. So 30% of your credit is now having an open and active account and making sure that that open and active account stays below 30% or less.
Okay.
Right? 15% is going to be your length of history. If you had a credit card for 10 years, your length of history is what? 10 years.
Yeah.
Which is why I tell people when you go shopping and they tell you, hey, will you like 10% discount on today's purchase if you open our credit card? The answer should be no. Right? And if you got a cup of coffee or something, just toss it in the air and run. Because if I have a credit card that's 10 years old, and I said yes to that discount, now I have another credit card on this hand that's 0. Well, 10 plus 0 is still 10. But I have to take those 10 years of history and divide it between my two credit cards. Everything about credit is an average and a percentage.
Is it just credit cards, or if I have investment properties, if I get a home every year to add it to the portfolio, for example, does it reset every time I get a new mortgage?
It doesn't reset, it dilutes your average.
Got it.
Right? So think
about, I see that even on mine. It says like the length of credit, but I got a credit card when I was 18 and I've never carried a balance, and it's still, I have a lot of debt, right, that I consider it all good debt. I have nothing that I consider bad debt. However, it says that I have a low, the length of history.
If you have a low length of history because you're constantly buying investment properties, pat yourself in the back. Of course we want that. But what I'm saying is, if you're 26 years old and you had that credit card your parents made you get when you were in college, right, for $300, and then every other month or every time you go shopping, you take out a new credit card, that's a horrible strategy. Yeah. Because you're never going to get a solid length of history. So that's 15% of your credit.
That makes sense.
And then 10% is what we call new credit. So every time that I apply, and notice I said apply, I didn't say I get approved. Every time that I apply for credit, they're going to do what it's called a HARPL. And then my credit score is going to go down a couple points. Why? Every time that I apply for credit, the FICO algorithm, it doesn't matter how much money, your credit score is not a representation of your financial wellness. Let's start there, right? You apply for something, the FICO algorithm simply thinks you're getting in more debt. So just in case, let's clip you for a couple points. And then the last one is what is called a credit mix, credit profile, whatever you want to call it. We like to use an acronym called RIMO, R-I-M-O. And these are the 4 types of accounts that are ever going to land on your credit report. Revolving installments, mortgage, open or other, AKA American Express. There's a bunch of online tools that you can do that show up as an open or other. So example, you have a house, a car, a credit card, and an American Express, and I have a house and 3 cars. Who has the better looking profile? You do. In order for me to look as good as you do to the banks and financial institutions, I will have to close 2 of my credit cards, go get an Amex, and get a car. Or buy 2 more cars, take out 3 American Expresses, and
why is that?
Buy 2 houses. It wants a 1-to-1 ratio.
Interesting.
It wants a 1-to-1 ratio, and I kind of look at it as almost being like a binary algorithm where it really likes the number 1, but it hates the number 0, which is like, I tell people, like, when it comes to your credit cards, don't pay them down to 0. Oh, well, I don't want to pay interest rate. Cool. Leave $1.
And why is that specifically?
So think about this. If last month your balance was 0, and this month your balance is 0, next month your balance is 0, what does the algorithm think is happening?
Interesting. So it thinks that you can't carry a balance.
It thinks you're not using it.
Well, what if you do use the bananas out of it like I do for work and for business and everything else? I rack up quite a bit on that credit card.
Good.
I just pay it off each month, but at all times I have a balance. It shows a balance, but I have it set to auto pay whatever the previous month's balance is. Is that a bad strategy?
It depends on when you're making that payment.
It's whatever the auto setting is. I don't know if it's the first, but whatever the 50, whatever it is, it just automatically gets paid. But anytime I look, I always have a balance, but it gets paid every month. Is that a bad strategy?
So it's when they report you. So what you want to learn is when do they report you?
How do you find that out?
You call them. You can call them and say, hey, Capital One, how are you, Matt? I just want to know what day do you report me? The 16th, fantastic. So 2 days before, right? Because it takes 2 days for that payment to process. 2 days before, you're going to pay down your credit card down to $3 or whatever that is, right? You don't touch it for 3 days, and then it's swipey time again, because that's how you're going to rack up your points, your miles, whatever, your benefits. And you do that all the way again till the 13th of the following month. You pay it down, not to 0, you just pay it down to whatever you want, and then you don't touch it. You wait for them to report you with a very low balance, and that's how you're able to continually bump your score. The other thing that comes from that is, and I'm sure you see it, here's an increase on your line of credit. Here's another increase on your line of credit.
Yeah.
That's how you start with a $2,000 credit card, and 2-3 years down the road, it's a $20,000 line of credit.
Is that a strategy if you want better credit to request? Because you can request additional credit. Do you want to have as high as they're willing to give you?
If
you have 20 now and you can get a $50,000 credit limit, do you want to ask for more?
You should always be asking for more.
Okay.
But the idea is, if my credit utilization is 40% and I don't necessarily right now have the funds to bring it down to below 30%. Well, what's the other thing that I can do?
Ask for more credit.
I can ask for more credit, and then that 40% of whatever, well, it just went down because my line of credit is ultimately more.
Sure.
Right? And it's the same exact thing. So there's very few things that you can manipulate when it comes to your credit score. It's going to be paying down your credit cards, right? And the other one's your length of history.
And this is something that your firm is able to look at to say, okay, what are your limits on each of these cards? This is a main consideration, I would imagine, based on what you're saying.
The number one thing we are going to look at is how are you managing your open and active accounts?
Yeah.
Right? Are you over leveraging? Because look, if you're coming at me with a 90% utilization and all your credit cards are close to maxed out or over the limit, you're not going to get any more credit.
Yeah.
No, right? The banks don't work that way. So the first thing is we're going to coach you, hey, how many credit cards do you have? And we're going to give them a strategy to get out from credit card debt, because we ultimately want them to have that under 30%, because now they have.
How do people get out of it at 27% interest? How do you get out of it when I could be wrong, I'm sure you know, but I think it's what, 26,000 is the average American credit card debt. It's somewhere in that ballpark, I think.
As a country, we owe $1.28 trillion. Sorry, $1.23 trillion in credit cards right now.
Yeah. So how does the average family who's on a fixed income typically, how do you start paying down that debt? Because your kid needs braces, right? The engine blew and now you need the X, Y, Z. It's like there's always something. It's never convenient. So how do you get ahead of it? What's the strategy?
So this is one of the things that I love about Dave Ramsey, right? He's one of the guys that made this noble approach very, very public. And what people do, I imagine, I kind of picture it as a garden, right? And each one of your little trees is a credit card. And somebody just grabs the hose and goes in there and just goes crazy. And hopefully everybody gets something. And then equate to that to people that make the minimum payment and then pay everybody else a little bit extra. You and I know that because of that 27%, that little bit extra is going to get eaten up by interest rate. It's never going to go. So the strategy is you pay everybody their minimum payment, because believe it or not, most people are not making just their minimum payments. They are paying a little bit extra.
Yeah.
So let's just pretend you're 5 credit cards for the sake of easy numbers. Your 5 credit cards, your minimum payments are $100. But then you look at your budget and you're paying $150 every month. Well, that means you have a $50, what I like to call payoff power surplus.
Okay.
Okay, so we're going to put that $50 to the smallest balance. Once we pay that down to below 10%, you got that $50 plus whatever you used to pay to credit card number 1. Let's call it $10. Now your payoff power became $60. You put it towards the next one. From smallest to biggest. And here's the beauty. Paying down a $300 credit card to $30 gets you the same amount of points than paying down a $30,000 credit card to $3,000.
Interesting. Because the utilization for each credit card.
Averages in percentages.
Yeah.
You know how many people are like, oh, I have a $100,000 credit card limit. Cool. How much of it are you using? Oh, it's like 70 grand. Cool. You're at 70%. My credit card is only $2,000 and I only use $50, dude. Guess what? I'm getting all those points. Everything is averages in percentages. So when you break it down, it's just 5 things. Do you have the right credit mix, and how can you build it?
Right.
Right. Are you or are you not paying your bills on time? Everything in your life should be on auto pay. Everything. How do you manage your credit cards? And are they all, hopefully just one, but are they all, average American has what, 5 or 6?
Yeah.
Something like that. Credit cards. And then you have, don't get your credit pulled more than 6 times a month. Or sorry, a year.
I was going to say a month.
Sorry, a year. Well, and I was going to talk about what happens to people that go car shopping.
Oh boy.
Yeah. You know exactly where I'm going. And then
I might not actually. I'm interested to know about it, but keep going and then we're going to circle back. Yeah.
And then the last one's going to be your length of history, right? That's why we don't open a bunch of credit, and that's why we don't close all credit.
Got it.
That's your FICO algorithm in a pie chart, 5 pieces. That's it.
Right. Well, now explain to me the car, because now you have me interested. So I know from what I hear, this is what you're here to spell potentially. When you're shopping, for example, for a mortgage, we're under contract. You do have good enough credit to get a mortgage. We know that. We have you pre-approved with bank number 1 before we even looked. You were a perfect buyer and you did exactly what we told you. But now we're under contract and they want to shop 2 or 3, 4 other banks to make sure they're getting a good deal. They're going to have to get their credit pulled. Each one of these is going to require a pull. I've been told that these, the credit bureaus will allow you to pull the credit for the same category multiple times in a certain window, be it 30 days, and it only counts as one pull. Is that an accurate statement?
Yeah. So The other thing
And
to
does
keep
that
in mind,
apply to cars as well?
when the FICO algorithm is looking at a mortgage pool, and just to play this game very, very safely, I go with 15 business days. You can shop around for a mortgage for 15 business days. And again, you're going to have people like, no, it's 30. Oh, I did it within 30. Cool. Awesome. But let's be safe, right? 15 days. The problem with low score or low credit score buyers when it comes to a car loan, you know this, they go to the dealership, they sign the application, and then the finance guy is back there doing his thing. What is he doing? If I have, you own the car dealership, right? And both of us work for you. And I'm like, hey, Matt, I'm going to do this loan. Cool. What does it look like? Oh, blah, blah, blah. 490 credit score. Are you, as the owner of that dealership, happy to keep a loan from somebody with a 490 credit score?
I don't want to give you that.
No. And so now I have to go and find a finance company. So I got to go take the application to him, and he's going to send it out to a bunch of different banks, right?
They're going to pull it 6 times or whatever. Yeah.
I have a client that got their credit pulled 27 times in 2 days.
Oh, boy.
Because it's Matt Rhine's Dodge, and across the street is Matt Rhine's Chevy, and across the street is Matt Rhine's
So
Jeep.
he jumped around to see who's going to give him the best.
But who told him to jump around?
Yeah.
Hey, go shop around. What's happening during that process is they're literally getting your application out, and you can ask car people. Like, you can ask people that work in the car, and they literally call it shotgun.
Shotgun.
They take your application, and it goes to a bunch of different banks. It's a practice that's been around forever, right? And while, and this can be changed because the bureaus, and not the bureaus, let me rephrase that. FICO can basically change the coding of the algorithm whenever they want. It's their thing, right?
Sure.
Just like Microsoft can update whether you, even if you like the new Outlook or you don't like it, guess what? Now you're stuck with it because Microsoft says you're stuck with it.
Right.
You and I don't get to make that choice. But as a lender, when you see 27 inquiries on a car loan, what that tells me automatically is none of those people wanted you because you're a liability. So that's why it's a really bad look. And I tell people, look, when it comes to shopping windows, because that's what you're asking me, is there such a thing as a shopping window? Yes, it's for mortgages, and to be safe, keep it at 15 days.
And so it should count as one pull for a mortgage in 15 days. But what about, you just said cars. So what do I do in a car situation? If I'm shopping and I don't have great credit, sometimes they're going to get the car that can be sold to them sometimes, right? It's like, who's willing to give me this car? It broke. I need a car. I got to go to work.
People got to go to work. People got to go, take the kids to school, church, whatever the case may be. That's why you're seeing people stuck in an 84-month loan with its 17% interest rate.
Yeah.
That person is never going to pay that car off. In fact, I can tell you, I've seen profiles because we see all this data. When we're coaching our clients, we see all this data. I've seen people borrow $40,000 for a car loan and they're going to pay back $87,000.
Yeah, that's crazy.
And so when people are like, well, I don't know what else to do, nobody will lend me. Go to who knows you.
Yeah. Find
your local credit union, right? That it's owned by their members. If you bank with ABC Bank, maybe start there, right? Nowadays, and it's not everybody, I'm not saying this is for everybody, but nowadays when you look at your banking app, you're pre-approved for something or other, right?
Yeah.
And it's already sitting on there. So understanding, and we can argue this both ways, by the way, but understanding that your credit score is directly tied to absolutely anything you're going to buy for the rest of your life.
Yeah.
A number that I would love to quantify is what is the difference in a lifetime between a 500 and a 700 credit score? Because I bet you it's over $1 million.
In terms of how much additional interest expense they're going to have to pay?
Or how much interest rate I'm not going to have to pay and put in my pocket, right?
Right.
And I like to believe that we're all millionaires. The problem is we're not leveraging our credit.
Yeah. Well, I think about your access to the capital to do how do you do these other exciting things to even have opportunities to grow your net worth if you don't have access to the capital markets? And by the way, it's I'm a big geek when it comes to autonomous driving, Tesla, and all this other stuff. I do think what's going to change a lot of the financial aspects of this country is when we no longer have to pay for cars. And so as you look at what's going to happen in the country, multiple cities now, autonomous driving is legal, and it's getting better very quickly. It's scaling. It's at a 200% clip of improvement, usually every 30 to 60 days. And so it's not going to grow by a linear fashion. It's going to be exponential. It's a hockey stick.
Yeah.
And when that happens, I think the cost per mile isn't going to be paying what we pay for Uber, and this is why it's kind of, the only reason I'm bringing it up is because Uber is really quite expensive. You don't want to use that every day for everything if you have to drive with kids and work and all the things, but it's going to be so inexpensive once it's autonomous and there's no human in the car and it's always electric and there's no maintenance. It's going to go down so fundamentally, it'll be so fundamentally different that the cost per mile, you would never buy a car. You'll never want insurance. You're going to not want any of the maintenance expenses. It's there all the time. They're everywhere. They're ubiquitous. You want it, it'll be here in 2 minutes and it'll cost you $2 to get to where you want to go. It's going to be wild. I think that's probably, that reality is maybe 10 years away, not 30, 40, 50 years.
But you can look at a model of that right now.
Yeah.
Look at Spain. Most people, I lived in Barcelona for a while. Most people in Spain don't own a car. Yeah. In fact, in Barcelona specifically, depending on the last number of your license plate, you get to drive certain days and certain days you don't.
Wow.
So Monday, Wednesday, Fridays, whatever, Sunday, if you end in an even number, you can go drive. Wow. The people that have an odd number on their license plate. So you can certainly look at that model and you're right. It is ridiculously inexpensive.
Well, it is going to be very cheap. This is going to be the most, I think it's good for a lot of people, their car payment is exceptionally expensive. It's compared to the rest of their other expenses. That's why some people can't buy a darn house because they're paying, $800 a month sometimes to get these cars, because their credit's horrible. It's not even like it's a Mercedes. It's not. And so I think when that goes down to a variable cost and it's inexpensive with no insurance or maintenance, I think it's going to help people if they channel their resources in an intelligent fashion to maybe get a home. And so I'm just interested, I don't know, it's just as you were speaking, as the first thing that came to my mind, how this might be a paradigm shift in the country whenever this does take place.
I really, really hope you're right.
I hope so too.
I hope you're right. But the last time that I looked, the average car payment is $740.
God help us.
That's way too much money. And every time that an industry faces to lose too much money, something comes up, right?
Yeah.
Like, look at the credit card companies versus buy now, pay laters, for example.
Yeah. Well, so we're going to get into that. So that's enough about the cars, but I do think that's going to be a wonderfully interesting thing to observe.
Imagine
in the
people
future.
having an extra $700 buying power.
Yes.
Right? For most people,
right.
That's right there, a third of their mortgage payment.
It's going to open up a lot of opportunities for people. But what you just said, I want to hit on that. It's actually one of the things I wrote down that fascinates me. The basically buy it now, pay for it later system. I've done it one time and I wasn't in love with it. Yeah, sorry about that. It was, I think the company was a firm. And so I wanted to buy this workout device. It was expensive. And I was a younger guy. I was like, I can't justify this, but I really want it. So I clicked the button in like 3 seconds. I had a $4,000 loan for this tonal thing. LeBron was ripped. I want to be ripped. So I clicked the button, right? And I got it. And it was so easy. And from what my understanding is, they've opened that bundle of financing option to like everything.
Yeah.
You can buy it now and pay for it later, like for all kinds of things.
You can order lunch for us right now and take out a loan on it.
Really?
It's true.
How is that impact? How do you see that?
Let me tell you how old I am.
Okay.
Let me tell you how old I am. When I wanted something that I couldn't afford, my mom will take me to Kmart and I will put it on layaway. That's how old I am.
Yeah.
Take that concept and reverse it completely. And we're going to leave company names, but one time, Affirm, Afterpay, Klarna, Cecil, FlexPay, you name it, right? The model is instant gratification.
Yeah. Dopamine hit, I bought it. Yep, feel great.
I don't have the money for it yet. And so what intrigues me, it doesn't intrigue me anymore, actually. After the numbers that came out, it doesn't. So last year, I was trying to figure out what this was going to look like at the credit reporting level. Okay? Because I know people had them. People told me they had them, but I'm not seeing them on the credit report. And so
they didn't report them?
No.
Or just not enough people had them? That it wasn't...
No. Everybody under the age of 26 is using this right now.
Oh, geez.
Everybody. So we didn't see them. And then I thought, oh, you pay this thing on time every month, yeah?
Your phone.
We all pay our phone on time every month, right? How come it's not on your credit report giving you points towards your payment history? So when does your phone bill land on your credit report? When is the only situation where your phone bill lands on your credit report?
I guess when you don't pay it?
When you don't pay it, exactly. Right. It becomes a collection, right? So my thought is, okay, those are called negative contracts, by the way. So negative contract, your gym membership, any type of delivery service, basically things that you pay for that are not necessarily on your credit report until you don't pay them. That's why it's called a negative contract.
Got it.
That's the way I looked at them. When it came to buy now, pay later, all these applications. And then when I freaked out is when I was checking out of Amazon and I can use my Chase card, right, which is already preloaded to my Amazon, or I had the option to do 4 payments, okay, on an espresso machine, Matt, $99. And I'm like, curiosity kills the cat. So I start clicking things, and then I realize, oh, this is an installment. It's a sales installment.
And is that appealing because it's not, because I already have credit card debt? I don't want more of that. So I can get this instead? Why not just put it on the Chase card?
Because most people, so Gen Z specifically, because they grew up with the don't use credit card model, they've seen their parents drown in credit card debt, they're scared of credit cards. And I've had this conversation all day yesterday and today as I've been doing different meetings and stuff. I would love to know the amount of dollars, I'm going to say millions, but I personally believe it's billions, that had transferred from credit card purchases into buy now, pay laters. Okay, I would love to know that number because it has to be millions.
Yeah,
I'm being conservative. The appeal is, it's right there. It's a button. How many times do we get things on our phone and there's the disclaimers? You don't read the disclaimer. You just click agree and continue.
Yeah,
right?
Long. Yeah, it's boring.
And here's the problem. Because people are not seeing the hard pull when they're using this type of loans, they don't think that it's going to go on their credit report. So I'll tell you a story. I have a current client, who has a $16 collection on her credit report. I asked, where is this coming from? Like, I needed to, when I saw it, I called her. Like, I don't deal with clients personally most of the time, but I called her because now that's how my brain works. And I look at the credit report. She has a collection with a firm for $16, $42, $62, $84, and there's one more, $112. And I said, what is this? And she literally tells me, I usually make a voice. I'm not going to make the voice. She tells me, oh, I ordered some Chipotle and I was too lazy to go get my credit card. So I just used buy now, pay later.
Huh.
Collection for $16 and a collection for $16,000. If they hit your credit report on the same day, you lose the same amount of points.
Yeah. Wow.
The problem now is that it's everywhere, right? If you buy a plane ticket, you can pay for it, or you can split pay it. You can buy a dinner, right? And split pay it. I don't know who it was. I can't remember which of the companies was, but they reported that 6 out of 10 of their transactions is people buying groceries.
Wow.
That's not good. We're taking out loans to pay out for groceries.
Yeah.
Are there people who need it? 100%. Okay. Is there a single mom that may not make it to the next 2-week paycheck? 100%. But I can tell you most of them are people buying crap that they can afford to impress people they don't care about. And then there's the second version of this. So because all this money has gone from credit cards now to the buy now, pay later, who's losing money?
I would imagine the credit cards.
The credit card companies.
I'm surprised they don't own the buy it now. Maybe they'll buy them and then they'll be happy.
Why, when I can just give you the same thing? Come on, man. I'm your credit card company. You know me, man. You trust me. Leave those guys. And let me ask you, have you noticed when you look on your phone at your credit card statements that there are certain purchases that says this qualifies for pay over time?
I have not seen that, no, but I'm sure it exists.
Any transaction now. I just bought plane tickets. I'm taking the kids on vacation, so I needed to get plane tickets. $362. I can go and pick a payment, and give me 1 second. I'll put it up for you. I can pick how many payments I want to make. I already swiped my credit card, by the way.
So within your credit card. And so then that'll...
So here's my credit card.
Uh-huh.
Well,
I have your credit card number now, so I'm going to make a few purchases myself after this.
good luck. It's got LifeLock. No.
Yeah.
Can you see that remark right there?
Pay over time eligible. There it is.
Okay, let's get curious.
These are things I don't notice.
Good. So you saw what I did. I just picked.
One click, and now you can do it over 3 payments, 6 payments, or 12 payments. But my point is, I don't understand the reason for this. Is this so it'll take it off of your credit card bill? So now you don't owe the $300, $400, $500 anymore on your credit card. You owe it separately and installment payments of $35.
You said it so nonchalant, but let's say it if I was a loan officer. Actually, let me play this game. I'm your potential buyer. I want to go see houses. What are the things I'm not supposed to do, Mr. Real Estate Agent?
You're not supposed to do the standard thing. Don't take any debt on whatsoever.
That's it. That's all I
Don't
want.
quit your job. Don't cuss out your boss. You know.
That's the first one I needed, right?
Yep.
I'm not supposed to do what?
Yeah. Take out any more debt.
Take out any more loans. So I already swiped my credit card. I show you the transaction. We clicked the button, and it gave me an option to take out a loan. So you're correct. The $300.
But will it come off of your credit card statement?
Yeah, it'll go back into my credit card limit, right? That $300
goes back.
So that goes back, but what just got created?
Yeah, a secondary loan. But does it get reported, this pay now? Does it get recorded yet?
It's a brand new installment.
So it will count as a new loan.
It's a new trade line. And you just told me that what you and I are going to go be looking at houses, I'm not supposed to be taking out new trade lines. Every time you do that, it's a brand new trade line. I'll tell you a story super quick.
Wow.
My friend Morgan. So I do classes for loan officers, right? And I was teaching them like, hey, this is how it works, blah, blah, blah. Here's what UQual can do for your clients, all of that. And then she pulls me aside, like, man, great person, thank you. And she goes, I'm 28 years old, and I've never had a late payment or a collection. I was like, awesome. Like, I'm proud of you, right? And she goes, but I've never been above a 680 credit score. And my brain glitched, like, eh. I'm like, no, that's impossible. If you tell me you have a 680 or you've never been able to go above a 680, I don't need to look at your credit report to know you already either have 2 delinquencies within the last 36 months or you have a collection in there. I don't need to look at your credit report. I already know. She goes, no, JP, never had it. I said, okay, let's do a review. We do the review. My friend had taken out 27 new loans within the last 3 months. And she'd been doing this constantly for years.
Yeah.
And they're basically, it's not a joke, but the way that I try to get people to understand what's happening is I want you to imagine your credit card giving birth to new installments because they are an installment. Installments is installment loan, same thing. So what's in it for the credit card company? Well, they just recover all that money that was going to the BNPLs, right? The buy now, pay laters. But on top of that, when I swipe my credit card, that's a non-secure revolving transaction, right? If somebody doesn't pay their credit card, period, there's nothing they can take from them. They'll send you to collections and it becomes a charge-off. In the mortgage world, if you have a charge-off, it affects your credit score, but it does not affect your debt-to-income ratio, right? Lenders do not look at charge-offs towards your DTI, your debt-to-income ratio. When I do that, have we clicked the button and taken out that loan for that credit card swipe, now it became an installment. And when you don't pay an installment, it becomes a collection. And when you have collections, the loan officer, it's going to count it against your debt to income ratio.
Wow. So the public service announcement here is resist the urge. Don't do that. Instead, use the credit card responsibly and keep it paid certainly below 30% and the goal of 10%. Is that essentially it in a nutshell?
I'll make it easier for you. I did a video about this on Instagram, and the first comment, my brother Fernando, if you can afford it, don't buy it. It's that simple, right?
If you can't afford it, don't buy it.
If you're not able to afford it, don't buy it.
Yeah.
Right? Because here's the problem. They're letting 18-year-olds run around with this.
Yeah.
And again, like, you can order Grubhub right now and take out a loan on your lunch.
Yeah. That's crazy. That's crazy. Well, that's easily said, but hard to do, I think. But the next topic I have to get to, I know we're getting a little long here, but the Vantage score is changing, right? This is what I hear, and I don't know what the heck that means, but I know enough to say I got to ask you about it. Mm-hmm. Is the score changing in a different way? I know you might have hinted at this before, but is there a new Vantage score? Is there a new way they're going to be looking at our credit?
So it's called Vantage 4.0.
Yeah,
and everybody's making a big fuss about it because I don't know what the source is, to be honest with you, but it was basically, hey, our housing authorities, right, Freddie and Fannie, which kind of finance everything, but Freddie and Fannie approved it. So now every loan officer and right, everything the loan officer gets, you guys get.
Yeah.
It's kind of like it rolls downhill. And this got approved back in 2018. This has been a thing since 2018. What I believe is going to happen, because let me tell you how many loan officers I have met in my career that have closed a loan using a Vantage score and not a FICO score. And if you are one of them, like, hit me up. I'd love to meet you.
Yeah.
0. I've never met a loan officer that has closed a loan with a Vantage credit score. So the way that I look at it is, if it gets adopted, it's not going to be a smaller company, right? Like Pioneers get arrows in the back. So it's got to be a really, really big mortgage company. Right. And then what they're going to realize is, oh, crap, what we thought was a 800 looks more like a FICO 560. So what do? Well, now in order for you to get approved, you're going to need a 900 credit score.
Yeah.
Right? Something like that. It's just moving the post down the line.
Got it. So it's a nothing. Okay, I was curious because it's something I've been asked, and I was like, maybe you should know a little something about it. So it's not something I'm going to lose sleep over, I suppose.
No, but the way that it's being presented to the public is that it's way more forgiving. It looks at trending data versus, oh, your loan officer looks at 7 years, and this looks at trending data. Yeah. How have you behaved within the last 28 months or something like that?
Right. Well, and so one of the last questions I have for you, it kind of relates, because I know you're Spanish speaking, and the last conference I went to described the fastest growing segment of homeowners in this country are all Spanish speaking. Mm-hmm. It is not just a little transition. It's going to be a major transition. Yeah. And they lag behind in home ownership at the present moment, but probably not for long, or at least so we all hope. So I want to know, I just what you've seen now that you're in this industry. Is there a way that we can capitalize and help that market? Because I think, at least here in Maryland, it is an underserved market. Mm-hmm. It's a market where Spanish-speaking people oftentimes don't know how credit works at all. I can't tell you how many people wait until they have the cash to be able to buy the home, which is why they live in a rental for 25 years. I'm not kidding you. And they say, I have $300,000 saved, Matt. I have to get to $400,000 before I can buy the home, but home prices keep going up, so I can't ever catch it. I had that happen a couple months ago. I said, you have $300,000 saves? Mm-hmm. And they're like, yes. Yeah. I'm like, you don't need that much. Like, they just didn't know. And so I don't know if that's something you're aware of. And so I just wanted to get your thoughts in general and how this is going to impact the real estate community in the country.
Yeah, so for obvious reasons, that's where my heart is, right? Yep. Like helping the Hispanic community to shrink the gap when it comes to financial and credit education. That's kind of my calling, which is why, if you look at my title, Diversity Relations. I was in Houston for an event a couple of months ago where we got the data from NAREP. 6 out of 10 homes purchased in the state of Texas so far in 2026 were Spanish-speaking families.
Wow.
60%, man. That's not a small number. Yeah. So learn Spanish, number one. Number two, the joke like the money under the mattress, the money in the shoebox, the money in the coffee can or whatever. That's not a joke. Like people think people legitimately have hundreds of thousands of dollars put away because nobody took the time to explain to them that homeownership is for you.
Right.
Because again, we come from a system where you couldn't get a home until you had the cash to pay for it.
Right.
Right. So we kind of brought that with us. But that's definitely an underset market. And here's, I guess in a sense, not my challenge. Yeah, sure. My challenge to you is definitely have that focus, because I'm telling you, your business right now, the one biggest difference between the Spanish Latino client versus your American client is the American client is very well aware of what the Fed is doing, what the rates are doing, blah, blah, blah. The Spanish client just wants to put their family in a home and we'll deal with it and refinance it in 6 months or whatever the case may be.
Yeah, that's wild. Well, I say purely from an economic standpoint, even if it's not your passion, which it clearly is for you, it's just like, I think people need to wake up to the market and the reality that there's a group of buyers, huge, that could be served in a meaningful way. It's rare you even have a lender who knows Spanish. It's very, I know they exist, but it's not often.
No.
And I don't see advertisements typically in Spanish. It's such an underserved market. I'd love to get involved in that market in a more meaningful way, just simply because I think it's untapped. And it's not untapped for long because people will catch on.
Especially in Maryland.
Yes.
Right? Like when I do this,
in Texas, I can get that. In California.
Arizona.
Yes.
But here, right? Like same thing here, Virginia.
Yeah.
Right? And that also has a secondary call to action. Non-Spanish speaking buyers that are on the fence, you need to get off your butt and get in the market, because guess what?
Yeah.
If you don't do something about it now, because of the rates, because of availability, because of inventory, because of whatever excuses you have, right? And I get it, right? When the market is what you want it to be, low rates and this and that, now you're going to be competing with 20 other people that have $300,000 cash saved. You're not going to win that.
Yeah. No, it's fascinating, but I'm passionate about it. I would love to get more involved in it. And I think I'm not going to be the only one. So. No. I think it's going to be massive. So, my practical takeaways. I'd love to wrap this up a little bit. So, for those that have hung out and listened to us for an hour now, it's how do they get started? Do they just go on the website? How do they at least get this conversation to begin? What's the way you tell people to go?
Yeah, for me, the best possible way for them to connect with us is something that they need to work on is get with your loan officer and say, hey, I want a connection with UQual, because when it comes through a loan officer, we give them a discount, we put them in a better program and so on. Because again, like if you're trying to buy a car, you can call us. 833-498-7825. We'll give you some tips and tricks on how to increase your score. But really, if you're looking to your point of go look at the house and then try to get qualified, no. Go to your loan officer, say, hey, I need help, but I want to get loan ready. Yeah. Can you connect me to UQual? Right. We work with almost every single company in the United States in the mortgage business. Wow. So they will get us connected, and we go through a free consultation. We look at the report. We coach them. Yeah. And then we look at what needs to be fixed.
Well, I was referred to you by Ayaz Rayamanji. He's a branch manager here.
First Home Mortgage, shout out.
Yeah, First Home Mortgage, shout out. They connected us, and he said you're one of the only legit folks he's ever met in this space.
Yeah, which says a lot coming from him. Like, thank you, Ayaz. You're the best.
He's a sponsor of the podcast. So shout out.
There you go. There you go.
But no, I think it's fantastic, and I hope I can tell you how I've typically see the chain. That's why I was saying, how do we start this? Most people don't go to the loan officer. Most people don't probably even come to you. Mm-mm. They end up clicking the button online to Zillow or these other platforms because they want a house. What I'd love to do is start the chain, so the people that are afraid to even click the button, so they need to first probably reach out to an agent oftentimes to start the process. If you have a good agent, they better have a good lending partner,
of course,
and then they can then connect you with UQual and get the better rates and all the rest. So I think that sounds like that's the loop we have to encourage people to go for.
Absolutely. And the other thing is that once you have a relationship with people like AS over at First Home Mortgage, right? He already knows the type of profile that we're going to have. So it makes the process more speedily. Right. And most importantly, it's a completely different thing to say, hey, Mr. Buyer, let me put you with your coaches. Let me put you with Matt, your realtor, with your loan officer. Have a team versus go fix your credit, come back in 6 months.
Right.
Because that person's not.
Well, I have to say this directly. How do people pay for this? Like, you said pay for performance. You have to wait 6 months now? Is that what you told me before you can charge anyone for these services?
For credit repair, right, they're not allowed to pay. What we do is, depending if you're coming refurb, in this particular case, let's talk about first home, they get an incredible discount. And it's based on every state. Every state is different.
So the lender is going to be paying this?
No, it's on the client.
Okay.
Right? But it's honestly extremely, extremely inexpensive. I'm going to speak for Maryland.
Okay.
In the state of Maryland, if you're being referred by a loan officer, it's only $99 a month. Okay. And to your point, this isn't just credit, it's financial wellness. We have an AI that does the budget for you. My average client is saving over $270 a month. We have people with 800 plus credit scores that only use the budgeting tool. Like me, I'm traveling all the time, blah, blah, blah. I got to make sure my 17-year-old is not out there buying crap, right?
Yeah.
So it's the mix. But yeah, it's on the client. I can tell you, I've heard horror stories. You probably know more than me, but credit repair companies that operate in Maryland charging people $1,500.
It's $99 is the least I've ever heard, but you don't charge more for that if I have a very complicated situation with the IRS or with this or that?
No. I deleted a medical collision. Let me rephrase that. We corrected a medical collection of $700 from your report. Your service $99. Oh, we corrected a charge off for $2,700. $99. It is illegal to charge people based on the size or the amount of that collection. You can't do that.
Interesting.
Mm-hmm.
Well, that's fascinating. So, I've learned a lot. It's not every one of these that I learned as much as I just did today. So I really do appreciate it. I had a bunch of questions and notes, and I think you managed to get through the gauntlet. So, I even think one of these days I might have to have you back with a different series of thoughts and questions. Now that we've started to peel this onion a little bit.
No, of course. And again, right? Like if we don't have this type of conversations, that's why I love doing this. Because at the end of the day, if we can bless people with knowledge, it's going to change their lives. I truly believe that.
I think so. And I think I trust anybody when I can see the direct line to the business. And so I understand it's in the interest of the lender. It's in the interest of the real estate community to help people be able to buy homes. Therefore, I then begin to trust what they have to say because I can see the path. Yeah. So I'm a realist in that capacity. So I think what you offer, as long as it's legitimate, which I know it is, or else I wouldn't be talking to you.
There you go.
So I'm excited for it. So that's it. So thanks again for joining me. Hopefully we've educated a few folks. And if you want to learn more, we'll have all your information in the podcast breakout. And if you want to reach out to us to help you with the process of getting ready to start that process, even if you don't have great credit, we have a solution now. We can help you work that through. So just reach out to the Matt Rhine Group. Our information is out here. And I hate to say this, but boy, the people at the podcast tell us to like and subscribe to this stuff.
Do it.
Yeah, it's officially a thing. Do you know we're number 19 in Uzbekistan right now?
Oh, there you go.
We're very, very popular over there. So shout out to those folks listening to us. Get your credit score up in Uzbekistan.
There you go.
All right, thanks so much.
Thank you so much.
And big thank you to our sponsor, First Home Mortgage. You can check them out at firsthome.com.